Okay, welcome everyone. So we'll start the first chapter of quantitative methods today, rates and returns. And many of the ideas that we're going to cover today have been covered in the prerequisite readings as well. So those who have joined for the first time, they should make sure that they watch the prerequisite readings, all the videos. But still, we'll try to make sure that whatever is relevant from the exam point of view, we cover it once again. Okay, so we'll try to make sure that, yeah, okay. There's a question that Vivek is asking. I wanted to make a quick check in regards to CFA scholarship. Yes, Vivek, please go ahead. The applications have opened, right, on 11th of Feb, I guess. Yes.
Yes, sir. So there are a few queries that I wanted to
Yeah,
check
please.
with you. So
Please go ahead.
is that possible to, connect with you after the class or?
Yeah, sure, sure. We can have a session after the class, Telegram call if possible. In the evening, maybe after 8 p.m., if that is okay for you.
Yeah, sure, sure. Yeah.
Okay, fine, fine. Okay, thank you. So let's start the chapter. Okay, now earlier also we discussed the three key interpretations in the prerequisite readings also. There are three key interpretations of interest rates. Okay, now the first interpretation, if you remember, it was the required rate of return, right? Required rate of return. Now, when I say required rate of return, basically the minimum return any investor must receive so that they can accept any kind of investment willfully, okay, happily. So that is the interpretation of required rate of return, the minimum return that the investors will demand, you can say, or they must receive, okay, to lend their capital willingly. Then what was the next interpretation? What was the next interpretation? We have already done this in the prerequisite reading. The next interpretation was discount rate. Okay, so discount rates were the rates at which the future cash flows were discounted. Basically, the equivalent present values of the future values, the rate which is used to discount or to convert that future value into present value, that is the discount rate. And the last interpretation, the third interpretation, was in the terms of opportunity cost. Opportunity cost. Okay, so opportunity cost is what? Opportunity cost, mainly you can relate it to opportunity cost of consumption. Okay, and I think this is perhaps the most intuitive one, because if suppose you are choosing to spend today rather than investing, you are letting go of the interest, you are forfeiting the interest that you could have earned by investing. So you can say that opportunity cost is nothing but the value which you are foregoing by by choosing any one course of action over another course of action. That is what opportunity cost is. Okay, so these three key interpretations are very, very important, and this is how we start this chapter. Next, we have the components. Again, this is also something which we discussed in the prerequisite readings. Now, the interest rate, it can reflect different kind of risk factors, right? And the investors, they should be compensated for all those risk factors. Okay, the first one is, of course, the most basic one. It is the real risk free. The first component is the real risk free rate. Okay, now you may ask that just now I mentioned that the components basically are mainly about the different risk factors that investors must be compensated for. So since this is a risk-free rate, the first component itself is a risk-free rate. So how it is the risk factor, how it is a component? See, technically it is a risk-free rate, okay, but uh, even when you talk about the time preference, for say current versus future consumption, as we discussed in the opportunity cost, at least you need a minimum level of return even if the other risks are not present. Okay, so even though we are calling it a risk free rate, it is still analogous to a kind of a risk factor component of interest. That the first, the basic component of interest rate, which is the real risk free interest rate, it basically represents the time preference for current versus future consumption. Okay. Next, you have the inflation premium, if you remember. Inflation premium. So, inflation premium is what? What kind of compensation? Inflation premium. Inflation premium is compensating for the investors, it is compensating the investors for the expected loss of what? Purchasing power, okay, over your investment horizon. So it is the compensation for expected purchasing power loss. Okay. Next component is the default risk premium. You have the default risk premium. So default risk premium is basically the extra compensation or the additional return which is required to compensate for what kind of possibility? Tell me. For the possibility of course, the word itself is quite self-explanatory. Default. What does default means? Default means that a borrower may fail to make their promised payments on time or in full. Okay. So that promise can be with respect to time also. That promise can be with respect to amount also. The compensation for that possibility is known as the default risk premium. Next, you have the liquidity risk premium, or you can simply call it as the liquidity premium. This also we discussed earlier. What is liquidity risk? Liquidity risk is the risk of not being able to convert your assets into cash quickly. Okay, when it is required. Of course, there are different kinds of liquidity risks also. That is a different module, in fact, a different segment altogether. In fact, in FRM part 2, we study liquidity risk itself as a separate module. Okay, so there is a lot of detail to liquidity risk, but at a very basic level, the extra return which is demanded by the investors for holding those kind of assets or holding those kind of securities which cannot be quickly converted into cash at their fair value. So if you are trying to say quickly convert some of the assets which are, let's say, very thinly traded, which don't have a very active secondary market, or maybe they have uh, very wide bid ask spreads. Okay, very few participants are there. In those kind of markets, there is a very high chance that if you have to convert your assets into cash very, very quickly, then you may have to face some kind of loss. You may have to sell it for less than its fair value. Okay. Now, can you give me some examples? Any examples of such kind of assets where you will have substantial liquidity premiums, let's say? And I mean, we can have comparative analysis also, because if you see, okay, there are some real estate. Very good, Karthik. Yes, absolutely. Real estate investments, definitely yes. If you compare the real estate market to the equity market to the stock market, okay, especially even in the stock market, if you have large cap stocks, large cap stocks are heavily traded, right? Heavily traded. There is massive liquidity in those kind of markets. So if you compare the real estate market with the equity markets, obviously real estate market is much less illiquid as compared to the equity market, because you can immediately sell your stocks to be converted into cash. But for real estate, if you want to do it immediately, probably that would be possible unless and until you make a distress sale. You sell it for less than its market value. Okay. Any other example from anyone? Just a few days back, last Saturday, in fact, 7th, we had this private markets conference in Bangalore. Okay. It was quite interesting by the CFA Society, India. And so, I mean, we can have definitely, I mean, as far as private equity is also concerned, if you compare it with the stock market, private equity also is something which is less liquid as compared to the normal stocks, right, in the stock markets. Then you can have, I mean, if you compare even in the stock markets, if you compare, say, small cap stocks versus large cap stocks, obviously large cap stocks will be more liquid. So this is the liquidity premium, that extra return that investors are demanding for holding those kind of securities which are basically illiquid, right, which cannot be converted to cash at fair value. Then you have maturity risk premium, or maturity premium, you can say. So this, again, the name itself is self-explanatory. We are talking about maturity over here. So the extra compensation which is required for holding long-term assets, longer maturity assets, maybe longer maturity bonds. Because the higher the maturity, you will see this in fixed income later on, the price volatility will be higher in response to the changes in interest rates. Okay, and we'll actually mathematically define some parameters like duration for fixed income securities, where we'll see that the longer the maturity of the fixed income instrument, the higher the duration is. Okay, and because of that, it is having higher sensitivity to changes in interest rates, which means that long term instruments are riskier as compared to short term instruments. So, investors will demand this maturity risk premium to you can say incur or to hold that kind of uncertainty, to bear that uncertainty. Okay, and maybe because of that uncertainty, the potential capital losses which are associated with those long time horizons. Okay, so these are the five components of interest rates. Okay, now let's talk about nominal interest rate. Okay, now when we discuss nominal interest rate, there is a very basic idea that nominal interest rate is nothing but the sum of, I mean, and that's an approximation actually. When we talk about nominal interest rate, okay, it is basically the sum of the real interest rate. Okay, in fact, we can write IR over here, no problem. Real interest rate plus the expected inflation rate. Okay, this is an approximation. So when we talk about this nominal rate, this is also nominal risk-free rate. Okay, the only thing is that now we have an extra inflation premium above this real risk-free rate to give you the nominal interest rate. So for example, when you talk about say instruments like US Treasury bills. In fact, we have discussed right in the prerequisite readings that US Treasury bills can be considered as a proxy for the risk-free rates, right? But again, are those real risk-free rates or nominal risk-free rates? That is very important to understand. So when we talk about US Treasury bills, 3-month bill, 6-month bill, 12-month bill, 90-day T bill, okay. So we are actually looking at the nominal interest rate and nominal risk free rates, to be very precise. Okay, why they are not real rates? Because they also have inflation incorporated in them. Okay, because when you adjust your nominal rates for this inflation, you will get your real interest rate. And we will see a lot of examples later on in economics, okay, which we have done in prerequisite reading also. Okay, so that's the same idea. So let's say we want to have a situation where you have a very high inflation environment, let's say. Okay. And in case of a very high inflation environment, the nominal return that you are being told that you will be given is say 10%. Okay. Or 8%. But there is a very low inflationary environment where you are being told that the nominal return that you're going to get by investing in the country's government securities or government bonds is say 6%. Then it is possible that, I mean, again, keeping other factors constant, we are not assuming any kind of changes in other factors, no geopolitical risk, no country risk, okay, no currency risk basically. So we are just assuming these two situations where you have a high inflation environment and a low inflation environment. In a high inflation environment, let's say you are getting 8 to 10%. In a very low inflation environment, you are getting 4 to 6%. It is possible that you might prefer 4 to 6% in a low inflation environment so that you account for that erosion in your purchasing power as well. And as I told you that this is an approximate relationship to understand the basic idea, but the exact relationship will be written like this: 1 plus the nominal interest rate is equal to 1 plus the real interest rate multiplied by 1 plus the inflation premium, you can say, or you can say expected inflation rate, whatever you want to call it. Okay, either you can say inflation premium or maybe you can say expected inflation rate. Okay, now let us come to the total return components. So we talk about basically two sources of return. Two sources of return. What are those two sources? One is, of course, the income yield, the income source, and then you have the capital gains or the capital source. Okay. Now, when we talk about income yield, so income yield is basically, you can take examples. Basically, let's say if you have a stock, okay, if you buy a stock, the stock pays you dividends, or if you buy a bond, okay, you invest in a bond, the bond pays you coupons, okay, interest. So the dividend payments or the interest payments, okay, or in case of a property, you can say the rental payments. So those kind of return sources, they fall under this income yield. Okay. And then you have capital gains. Capital gains basically reflects the changes in the asset price itself over the holding period. Okay. So if you have purchased the stock, whatever increase you have in the price of the stock, that is your capital gain. Okay. And remember one thing, that some of the assets, they may only provide one component. Okay. So generally, I mean, when I say solely provide one component, generally it is the capital component, the capital gain or loss, because there can be, say, stocks which will not pay you any dividend, non-dividend paying stocks. There are many non-dividend paying stocks. So they will only give you capital appreciation. Similarly, you have zero coupon bonds. They will only give you capital appreciation. Okay. Next, let's talk about the holding period return. So when we want to calculate the holding period return, so we start with a single period return actually. We start with a single period return. Now, single period return, basically the return which is earned over one time period, one specified time period. Okay. So what is the formula? Formula is this: R is equal to P1 minus P naught plus I1 divided by P naught, where what is P1? You can call it PT also. What is P1? P1 is the ending price. P naught is the beginning price. And I1 can be any kind of income which is received during the period. Okay. And for the sake of, simplicity, we generally assume that this I1 is received at the end of the period, although practically this may not necessarily be true. So basically what we are doing, we are ignoring the time value of money over here, because you see, there is no future value, present value, compounding, discounting as such in this formula, right? Okay. So this basically can be broken down. If you properly try and understand this, you see this part is your capital gains part. Okay. And this part, of course, is your income part. Okay. Some times it can also be written like this. Sometimes it is written as, say, P1 plus I1 divided by P naught minus 1, because P naught minus P naught is 1. So you can just rearrange the terms, and sometimes you can write it like this. So basically, the ending price plus whatever income you received, okay, divided by the initial price minus 1. Okay. So if you just want to take a practical example, let's say you have a stock which you purchased for, say, $25. Okay. So this is your P naught. And you get a income or a dividend of, say, $2. Again, on a very higher side, I'm giving. And you have the final price, P1, as, say, $30. Can you tell me what will be the holding period return? The single period HPR. Okay, this is also known as HPR sometimes. What will be the HPR? How much you are getting? Quickly send your answers. Okay. So everyone is getting 28%, right? So basically, HPR is nothing but this P naught, sorry, P1, 30. Again, I can use any version of the formula. So 30 minus 25 plus 2 divided by 25, right? So you're getting this as approximately 28%, right? 0.28 basically, right? Okay. Now, what if I want to convert this a series of single period returns, in fact, into multi-period return? Okay, so when we talk about multi-period return, we are just compounding the returns over multiple periods. Okay, so again, HPR, say multi-period, say let's say we have say till time period T. So this will be equal to 1 plus HPR1 multiplied by 1 plus HPR2 dot 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 dot. So again, we just keep on multiplying this 1 plus HPR say T, and this will be minus 1. Okay, the why I've written this small t, basically I just want to denote that this was the period between t minus 1 and t. Okay, this is not for the full period t. So this t basically stands for, because this 2 does not stands for till year 2. This 2 stands for during year 2. So that's why this t stands for during year capital T, which means between t and capital T and t minus 1. Okay, and this HPRT, it denotes up to the entire time period T. Okay, so if you want to just compound the returns across these multiple periods, you can just link them like this. Okay, so this is just the linking of single period returns, nothing more than that. Now let us discuss arithmetic mean return. Again, the same idea that we have discussed earlier in prerequisite readings. So what are arithmetic mean returns? Arithmetic mean returns, basically it represents the simple average of all the holding periods returns that we have discussed. Okay, so what is the formula for arithmetic mean return? Say we can call it as R bar. Okay, so it is nothing but R1 plus R2 plus up to R, say T again divided by T. Okay, so if we take an example, let's say if I give you that there are three returns, let's say the first year return is say negative 60%. The next year return is, let's say, uh, plus 40%. And then you have R3 as, say, 30%. Can you tell me what is the AM quickly, the arithmetic mean return? What is the arithmetic mean return? Negative 60% plus 40% plus 30% divided by 3. This is equal to, correct. So 3.33%. Okay. Now, if we come to the next part, which is geometric mean return. So geometric mean return, it actually it calculates the compounded rate, the compounded annual growth rate. Okay, so if you want to define it properly, if you want to understand it properly, basically it is that single rate. If that rate is earned consistently year after year, that would produce the same ending wealth. Okay, so it is basically a measure of the historical compound growth. It is more accurate for the growth part. Okay, so let's say if I want to define it, I can define it like this: RG, again bar, is equal to 1 plus R1 multiplied by 1 plus R2 multiplied by up to 1 plus RT raised to the power of 1 over T. So we take the Tth root of this product and then we subtract 1 from it. This gives my geometric mean return. So if I want to take the same example, say R1 is given as negative 60%, R2 we took as 40 and 30, right? R3, right? So R2 is 40 and R3 is 30%. Can you send your answers for the geometric mean in this case? Please send your answers quickly. Quickly send your answers. How much we should get? So it should be 1 minus 0.6 because R1 is negative 0.6 multiplied by 1 plus 0.4 multiplied by 1 plus 0.3 whole raised to the power 1 over 3 minus 1. Please send your answers. Calculate and send your answers. Waiting for your responses. Okay, so Vivek is getting 0.099. Is it 0.099% or is it's actually 0.099? Okay, so in the last case we were getting 3.33%, which means we were getting actually 0.0333, right? In this case, is it 0.099%, Vivek? Oh, okay, you are getting 9.94%. Okay, let others also verify. So this will be equal to 1 minus zero point 0.6 is 0.4 multiplied by 1.4 multiplied by 1.3. Are you sure that you're getting this? Raised to the power 1 over 3 minus 1. Because this number, see, if you multiply 14 times 4, you get 56. Even if you multiply 56 times 1.3, I don't think you're going to get more than 1. So this number probably will be less than 1. And if something is less than 1, its cube root will also be less than 1, which means you should get a negative answer, I think. Check once again. zero point 4 times, chalo, let's do it step by step. Tell me, what is 0.4 times 1.4 times 1.3? Okay, now you're getting negative 0.1004. Okay, is everyone getting the same result? Check, because this number seems to be less than 1, right? So 0.4 times 1.4 times 1.3 is how much? And then take the cube root of that. I think Jashankar is right. It should be somewhere in that range only. Do it quickly, otherwise I'll just have to do it on my own using the calculator. I mean, I just want at least two answers to match so that we can just validate. And the whole point of live classes, as I said, is you guys solving questions. Okay, because if I take my calculator and I give you the solution, then there's not much point, especially if it's an easy question. It's not a difficult calculation or at all. Anyone who can validate the answer that Jai Shankar has got or anything else you are getting, please let me know. Do it. Keep on trying. zero point 0.4 times 1.4 times 1.3. Then raise it to the power 1 over 3. See what I do in the calculator. See, 1 over 3 is 0.333. We know that. So we can write 0.3333 directly in the power as y raised to the power x. But you know what I personally prefer? What I'll do is I'll first multiply these three, okay, in the calculator. And then I will press y over x, okay. And then I will press 3, okay. And then I will press 1 over x, okay. Because as soon as you press this, see, we'll do it together. See, when you do 0.4 times 1.4 times 1.3, sorry, zero point 0.4 times 1.4 times 1.3, you get 0.728, correct? So we have 0.728 raised to the power 1 over 3 minus 1. So I can directly raise it to the power 0.33. I can do y raised to the power x. So you see there is a button y raised to the power x in the BA2 plus calculator just below tan. So y raised to the power x, I can do 0.333. But it's better to make sure that you are as exact as possible. So you press 3 and then you press 1 over x. You will automatically see 0.333333. And then when you press equal to, you are getting 0.899588 minus 1. So minus 1 gives you absolutely correct, Jashankar. It is negative 0.100412 or negative 10.04%. Okay, is the calculation clear? Okay, fine. So you see the difference. I mean, for the same numbers, we were getting the arithmetic mean as a positive number, 3%. So you could have been misled into believing that your return is overall positive. But now you see that your geometric mean is actually negative 10.04%. Okay, what is the interpretation? The interpretation is that, let's talk about, say, for this geometric mean. The interpretation for this geometric mean is that if you are an investor and you achieved, say, these three returns in 3 consecutive years, analogously, if suppose another investor earned this in amount of return every year for 3 years, so negative 10.04% every year for 3 years, that investor would have achieved the same ending wealth as the first investor who experienced this actual sequence of returns. That is the true compound annual growth rate. Okay, and that is why we say that geometric mean is the true compounded measure of wealth accumulation. Okay, it provides the more accurate measure of wealth accumulation. So AM was actually, arithmetic mean was actually overstating the growth rate, right? And this will actually happen when there is a high volatility. Okay, so if you compare arithmetic mean versus geometric mean, you will find that arithmetic mean is sometimes, and in fact most of the times, biased upwards, especially if there is very high volatility. Okay, it is biased upwards. Yeah, the only exception is that unless all returns are equal. Okay, and also this bias, it actually increases with the variability in return or volatility in returns, you can say. You see, these returns were very, very volatile, negative 60, then 40, then 30, massively volatile. And that's why it was biased upwards, and this bias was actually increasing with this volatility. Okay, this is massively biased. You compare negative 10% with 3%, massively upward biased, right? Because they are so volatile, the returns. And this geometric mean is nothing but it is the true compound growth rate. Okay. And obviously, the geometric mean return is less than the arithmetic mean return. Of course, the equality sign will hold when all the returns are equal. So, when will you use which kind of returns? If you want to only have single period forecasts, then arithmetic return is okay. But if you want to have multi period performance, then you may need to make sure that you always use the geometric return. Okay. Now let us come to the harmonic mean return. This is very, very interesting. Okay. Now, harmonic mean mathematically also, it actually uh, it serves a very specialized purpose. I just want to ask one thing. Just a minute. Yeah, the screen is very clear, right? There are no spots, right? Okay, I think it's on the monitor. Sorry, it's not on the PPT. There's a slight spot. I felt that it might be disturbing the visuals of the PPT, but it's not there. Anyways, so harmonic mean in mathematics also it serves a very specialized kind of purpose. In finance, I think it's even more specialized. A very, very specific application is cost averaging. When suppose you are making periodic investments of equal amounts, which we generally tend to do as investors. Okay, we always try to cost average. And in this cost averaging strategy, harmonic means application becomes very, very relevant. Okay, so what is the formula? The formula is harmonic mean RH is equal to n divided by 1 by R1, or in fact, it's better that we use T only to make it as consistent as possible. T divided by 1 by R1 plus 1 by R2 plus up to 1 by RT. Okay. So this is about harmonic mean, the formula. And what are the applications? As I said, the applications can be cost averaging. Cost averaging. Okay. You'll find that in these P ratio calculations, the application of harmonic mean is extensive actually. One very important feature that you will actually realize when you deal with harmonic means is that it actually reduces the influence of outliers. So it reduces the outlier influence, you can say. Okay, and of course, the weight is the reciprocal of the returns. And the same formula holds true even if you apply it for cost or price. So instead of returns, if we go for prices, we can have the harmonic mean of the prices or costs as equal to t divided by 1 over x1 plus 1 over x2, or in fact we can write the numerator as n this time. Okay, so n divided by 1 over x1 plus 1 over x2 plus dot 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 1 over up to xn. Okay. Okay, now let us try and understand this cost averaging part using a very, very simple example. Let's say in scenario A, we invest, say, $1,000 when the price, we invest $1,000 in a stock when the price of the stock is, say, $20. Okay, so price of the stock is $20 this time. And I'm not writing dollars every time. Okay, so the number of units that we buy today is 1000 divided by 20, right? Which is how many units? 50 units. Okay, so 50 units of stock we buy today. Then let's say we again invest the same amount of money. Okay, we again invest $1,000. Okay, USD 1000, and this time the price is not 20 now. This time the price is 25. Okay, so what is the total number of units that we have bought this time? The number of units that we have bought this time is equal to 1000 divided by 25, which is nothing but 40 units, right? So overall, how much we invested in total? We invested $2,000 in total. Okay, and the price that we want to find, that we paid per unit, the average price that we paid per unit will be how much? Total amount invested divided by total quantity. So total amount invested is how much? 1000 plus 1000, which is 2000, divided by the quantity, which is 50 units in the first case, then 40 units when the price was 25. Okay, so 2000 divided by 90, right? Which will give you how much? Correct, 22.22. Okay, so this is your average price which uh, which you paid per unit. Okay, if you combine both the scenarios. Now, instead of calculating the quantities every time, you can apply a shortcut, okay, using the harmonic mean idea. Okay, so you can apply a shortcut over here. Now, because we are investing the same amount of money each time, the average price will be simply the harmonic mean of the individual prices. Okay, so we can directly write XH as equal to 2 divided by 1 over 20 plus 1 over 25. Okay, you can calculate this, you can check this. This will also give you the same result. This will also give you the same result, which is 22.22. Okay, so if suppose this kind of a question is asked in the exam, you can directly use the harmonic mean idea. Now, one small warning I want to give over here. By mistake, do not average the quantities. Okay, don't do 2 divided by 1 over 50 plus 1 over 40. Okay, in fact, I actually made that mistake once. Okay, so we are not averaging the number of units. Since the investment amount is fixed, the correct shortcut is the harmonic mean of the prices or the costs. So whenever equal money is invested at different prices, the average purchase price will always be the harmonic mean of those prices. Okay. Now, let us cover some important mathematical relationships between these means. So now first we have this well-known inequality, AM greater than GM greater than equal to HM. Or you can also write it in the opposite manner, HM less than equal to GM less than equal to AM. Okay, now you may remember this from school, but think about why this happens. See, I'm not going to derive it because the mathematical derivation, of course, is not a part of the course. Now we can just think of it intuitively. See, the arithmetic mean simply averages the numbers directly. Okay, so actually it gives the largest value. Okay, because large observations will you can say pull it upward the most. Okay. Now, geometric mean, it introduces multiplication as well as roots. Okay, so it dampens some extreme values, and that is why it typically sits below the arithmetic mean. And harmonic mean, in fact, goes one step further because we saw that it works with reciprocals. So large numbers become small when we take reciprocals, right? So large observations actually get penalized even more. That pulls the harmonic mean down even further. Okay. Now, when we move to finance, the same structure will appear with returns. Okay, so instead of writing only HM, GM, and AM, we'll write arithmetic mean return. And in fact, this time I can write in the opposite order. Okay, so I'll write arithmetic mean return greater than equal to geometric mean return greater than equal to harmonic mean return. In fact, I have made a YouTube short also about this, that how a general inequality of AM versus GM also translates to a finance inequality of AMR versus GMR. Okay, the idea is the same. So arithmetic return is just the simple average as we discussed. Geometric return, it reflects compounding, and harmonic mean return, it usually appears when we are averaging some ratios. Okay. Now there is another useful relationship over here. When you multiply AM with HM, okay, you will actually get the GM square. And again, this also applies to arithmetic mean return and harmonic mean return and geometric mean return. Okay. But one small and important mathematical caveat I would like to add over here. One restriction, that these relationships, okay, these relationships, all of them, in fact, the inequality also and this one also, these relationships will actually hold when the numbers are positive. Okay. So these relationships hold when the numbers are positive. When the numbers are positive. Because if negative numbers enter into the picture, in fact, it should not even be zero. Okay. The numbers should be positive. If negative numbers enter into the picture, okay, especially for geometric and harmonic means, these relationships will not hold, or in fact sometimes may not even be defined. So please be very careful about this. Okay, fine. Now let's discuss trimmed mean and Winsorized means. So what are trimmed means and Winsorized means, and why do we even do the trimming and Winsorizing and all these things? What is the point of doing this? Okay, see, if suppose there are a large number of outliers in your data set, and you are worried that these outliers might distort the mean, but still you want some kind of measure of central tendency. We have done this, right? Measures of central tendency about outliers also we have discussed in prerequisite readings. But what is something that you can do with these outliers? So let's say you have this data set where, let's draw it, let's try and visualize it. Okay, so it's something like this. You have, say, this kind of data set. You have a lot of data in the central part. Okay, and then again, as you move ahead, you have less number of observations, and then there are some outliers also. Some here there's an outlier. Okay, something like this. But you want to find out the measure of central tendency, and you are worried that these outliers may actually distort your measure of central tendency. So what you do, in case of trimmed mean, you actually remove a certain percentage of outliers and then you only consider the middle data. That is your trimmed mean. So you eliminate the outlier influence completely. You actually eliminate the outlier effect completely. Okay. But if suppose you don't want to eliminate them completely, still you don't want to distort the mean also. So what is the solution? You don't want to let go of them. You don't want to trim them completely, but you don't want them to distort your mean also. So what you do in those cases, you replace these values. Let's say there are 5 values over here. Okay. So these 5 values will be replaced by the boundary value which you used while selecting the outliers. Okay, so Windsorize mean is actually replacing these outliers with less extreme value. Okay, replacing, this is I, replacing the outliers with less extreme values, or you can say boundary value. Okay, or you can say boundary values or the nearest observation which you are considering. Okay, so similarly, this also. That is the idea behind Windsorize means. Now, the calculations and all those things are not a part of the learning objectives for trimmed and Windsorize means only the visualization. I think you understand. You will be able to deal with the concept, and mostly conceptual questions are asked. Even if calculations are asked, it will be very simple. You will have a data set and you will know which observations to consider and which to eliminate. Okay, for trimmed mean and which to replace them with for Windsorize means. Okay. Now let us come to the very important part of money weighted versus time weighted rate of return. Okay, so let's start with the money weighted return. Okay, so in money weighted and time weighted, basically we are seeing what is the impact of individual cash flows on the performance measurement. So we are analyzing, we are comparing them. Okay, that is what we are doing. Now, in case of money weighted return, the money weighted return, it actually applies the concept of internal rate of return. And what is the internal rate of return? Internal rate of return is that discount rate which makes the present value of cash inflows equal to the present value of cash outflows. Okay, so in other words, the rate which will produce a net present value of zero, and this is how we write it. If you want to write it, you will say you want to make the present value of inflows is equal to the present value of outflows. So that rate, the rate which makes the present value of inflows equal to the present value of outflows, that is your money weighted return, or simply the internal rate of return. Okay, mathematically, as I said, it also implies that the net present value will become zero. Okay, and if you want to write it, you will write it like this: summation of the cash flows at different points in time, okay, divided by, of course, the 1 plus money weighted rate of return, or IRR, raised to the power t, where t is equal to from 0 to t. And we'll see an example. This will become very clear. This is just an expression that we are highlighting the net present value becomes equal to 0. We are using this expression to highlight that the net present value becomes equal to 0. That is the idea. Okay. And this money weighted rate of return, when we compare the two, we'll see that this reflects the actual investor experience. But as far as manager performance is concerned, we have to be very careful which return measure we are using. So first, let's take an example. Let's take an example of money weighted rate of return. Let's say you are, uh, let's draw a timeline in fact. So in the beginning of the year, you invest, say, $100. Okay. So your cash outflow is 100, and that's why we'll write negative 100. Okay. And then after year one, you have, say, a return of, we can take extreme return also if you want, just like we used to illustrate the difference between arithmetic mean and geometric mean. We can take the same idea and we can take an extreme return. Or else, if we want to show the effect of dividends, then I think I have to frame the example in a different way. So there are two approaches actually. Let's take the extreme part. Okay, let's take you suffer again a negative 60% return, let's say in the first year. Okay, negative 60% return in the first year. And after that, after suffering that negative 50% return, you actually add another, say, $200. Okay, I'm just trying to make this example very extreme so that it becomes very clear why we have such a huge difference and which measure we should consider. So if you suffer a loss of say 60%, how much you are left with? 40, right? After that also, you add another $200. Okay, so your cash outflow is again $200 in the first year. Okay, at the end of year two, you have a return of say plus 40%. Okay, and then you take out some money. In fact, let's make this addition even more so that while we withdraw money, at least something is left in our account. Let's say we invest $500. After suffering a loss of 60%, we invest $500 more, and then you have a gain of 40%, and you withdraw some amount. You withdraw, say, $300. Okay, so this plus 300, why? Because it is a cash inflow for you. You have withdrawn this money. Okay, and then finally, at the end of year three, you have another say plus 20% return. Okay, now I chose this plus 20% just to highlight the fact that if you have negative 60, 40 and 20, if you take the simple arithmetic return, basically you are ending up with zero in case of arithmetic return. If you use it as the correct measure, which we just discussed earlier, that it is very, very misleading. So that's why I'm choosing these numbers. Okay, and if you have plus 20%, now tell me what will be the exact amount. See, these are the amounts that we have added or withdrawn. Now, what we are left with also we need to calculate. See, after suffering a loss of 60% on $100, what is the amount that we are left with? After suffering a loss of 60% on $100, what is the amount that 40, correct? So we are left with 40, and after 40, we also add our own 500. Okay, so don't confuse and add 40 and negative 500. This is an outflow, which means that we are adding it to our portfolio. So can you tell me to the total portfolio now at the end of year one, how much money we have? At the end of year one, how much money we have? Correct, 540. 500 we have invested from our side, and 40 we were left with, correct? So 540 is something that we are left with. Now this 540 gave us a gain of 40%. It gave us a gain of 40%. So can you tell me how much capital this 540 becomes after a gain of 40%? Just multiply 540 by 1.4. How much you are getting? 540 times 1.4 is equal to how much you are getting? Niyaz, 540 multiplied by 1.4. You are gaining 40% on 540. Okay, so is everyone getting 756? Okay, so 756 is the capital that you have now. But after that also, at the beginning of year two, how much you are investing? How much more you are investing? How much more you are investing? Correct, 300. No, you are investing. You are, yes, correct. You are withdrawing 300. Absolutely correct. You are withdrawing 300. You're not investing, you're withdrawing 300. Absolutely correct. So your net portfolio amount, see, I have written this plus for to signal that you are withdrawing, it is a positive cash flow for you. Correct. 456 balance. Absolutely correct. 456 balance. Okay. And now tell me, if this 456 increases by 20%, how much you are getting? If this 456, you are getting 547.2. Okay. You are getting 547.2. So basically you want that interest rate, the IRR or the money weighted return will be that interest rate which makes your net present value equal to zero. That is, the present value of outflows will be equal to the present value of inflows. Okay, so if I have to frame this in a form of an equation, How will I do it? We need to understand what are my cash flows and what are my cash outflows and what are my cash inflows. Okay, so I invested 100, then I invested 500. Okay, then I got 300, and tell me what will be 547.2. Is it a cash outflow or a cash inflow for me towards the end? Is it a cash outflow for me or a cash inflow for me towards the end? This 547.2. Exactly. This is an inflow. This is an inflow. Okay. So you see, I will write this CF0, the first cash flow is actually negative 100. Okay. Now tell me very, very carefully, what is CF1 or C01? In fact, in terms of BA2 plus calculator, the notation is something else. We will use the CF buttons. Okay, so it is actually C01, but let's make it very simple to understand right now. We'll make it consistent, and I'll also show you how to use the BA2 plus calculator also. Okay. So CF0 is negative 100. Now my question is CF for CF1. Will you write 540 or will you write negative 500 or will you write 40? Tell me. Very good. Because your cash flow is important. Absolutely correct, Karthik. It is your cash flow which is being considered, which is actually negative 500. Absolutely correct. What about CF2? Correct, 300. And what about CF3? What about CF3? Karthik, will you leave that 547.2 or will you take it? Correct. It is 547.2. It's not zero, right? That's why I asked this question. So it's 547.2. Assuming that you guys have done the calculations correctly, right? Now, if I want to frame an equation, negative 100 is my CF0. Okay, and I mentioned that this is the idea of net present value being equal to 0. So negative 100 is being paid today. Basically, 100 is being paid today itself. So that's why when I write negative 100 and if I try to discount it by 1 plus IRR, I will raise it to the power of 0. Okay, because negative 100 today is negative 100 only. Because anything raised to the power 0 is 1. So negative 100 by 1 is negative 100 only. Plus the first cash flow, which is negative 500 divided by 1 plus IRR raised to the power of 1. Okay. Plus the next cash flow, which is 300 divided by 1 plus IRR raised to the power of 2 plus 547.2 divided by 1 plus IRR raised to the power 3. This should be equal to 0. That is the idea behind money weighted return. You are applying a constant discount rate to all your cash flows, which makes sure that the addition of everything, the present value of all the cash flows, basically the net present value, becomes equal to 0. That is the idea. But in the exam, will you be able to solve this cubic equation? In fact, it's not even a direct cubic equation. When you take the denominator and take the LCM and everything, it will become even more complicated. Is it possible for you to solve this equation in the exam directly mathematically using algebra? No. Then what do? We use which buttons? We use the BA2 plus calculator, the CF buttons, the cash flow register. Okay, we'll go for. So just open your BA2 plus calculator, and if I'm not sure if anything is there already or not, so please make sure that you press second and you press clear work so that everything is removed. Okay, but again there is a catch. Sometimes what happens, in fact candidates make this mistake, they press second clear work directly. Okay, so even after that some elements are left in the CF buttons. It actually does not clear the cash flow registers, okay, the memory registers. So if you want to clear that, first press CF. You can see the second button, okay, and then press the second button in the second row, and then press second and then press clear work. So clear work is basically above this CEC. So I'm referring to clear work. Please press this. So can you see that CF0 is now set to 0.000 if it was not there earlier? Is CF0 equal to 000 for everyone? See, this is very, very important and interesting. So please participate. Okay, be active for everyone. Everyone should reply. Set to 0. Karthik, Shankar, Sharon, Niaz. What about you guys? Shubham, done? Okay. Okay. So till that time, Niaz, if you don't have it, you can download either on Android. In fact, the iPhone app is a little better, I'll say. There is an app, BA Calc Pro. Okay, BA Calc. You can get a paid version also, just for that till the time you don't have the calculator, because sometimes even the app uh, becomes a little buggy, and it can give you incorrect answers. But we will assume that today will not be that unlucky day for us. So please, do those who okay, Sharon, those of you who don't have the calculators, please open your phones, Android or iOS. Just download that BA Calc Pro app and then start using it. Okay. So when you do it, you will find that. Acha, I'll also tell you the author on iOS. I think I had mentioned this to the other candidates also in the prerequisite classes. Let me check my phone. Wait. Okay, App Store. BA calculator. Yes, you'll find two versions. You'll find that there's a BA 2 plus emulator also. Okay, that also has very good ratings. But this one, uh, whose author is Angel Montana, I think that is the least buggy, if I'm not wrong. So you can use any of them. I think now probably this, use the Angel Montana one only. Okay, that is the least buggy. BA financial calculator. Okay, so let's start, guys. Let's start. Press 100, type 100, and then a plus minus sign, and then press enter. So 100 and then plus minus sign and then enter. Can you see CF0 has been set to -100? Has it been set to -100? Yes. Now press the down button, the fourth button in the first row. Press this down button, the fourth button in the first row. You find C01, correct? Okay. So in C01, again, press 500, then plus minus sign and enter. 500, then again, a plus minus sign and then enter. Can you see C01 has been set to -500, right? Okay. Then again, the down button, you will find F01. That is for the frequency. You don't need to enter anything because that cash flow is only occurring once. So that part you'll understand later when you solve more complex problems and when you get more acquainted with the BA2 plus calculator, even that part will be clear. But for now, we are keeping it simple. F01, since we have taken only once that kind of cash flow, we are just ignoring it. It is already set as 1. So we press the down button twice, down and then again down, so that we arrive at C02. Now, once you arrive at C02, you will press 300, right? You will press 300, correct? Okay, so 300 and then enter. And finally, the last cash flow is how much? 547.2. So again, press the down button twice, and then press 547.2. Of course, you enter, don't press it. There's no separate button for this. So it's better that I write it like this only. 547.2, 547.2, 547.2, and then I press enter. Okay, 547.2, and then I press enter. Then again, when you press the down button, F3 will be equal to F03 will be equal to 1. So it's not actually required. But anyways, just to check, you can press it. It's not required. Okay. After that, you can directly press IRR and then press CPT, because whatever is being displayed right now in IRR, that is maybe the previous calculation. So don't worry about that. Just press IRR and then again press CPT. How much you are getting? How much you are getting? Karthik is getting 21.07. Is everyone getting 21.07? Is everyone getting this 21.07? Okay, so two of you are at least getting it. So this is the correct answer. 21.07 is your money weighted return. Okay, so even though you see the numbers which for the returns which I chose, negative 60, 40, 20. If you take a simple average, you're going to get zero. But the money weighted return is actually 21.07%. Okay. Now, let us discuss time weighted return. So, time weighted return is basically the return which does not, again, those cash flows which we added in the money weighted return, the time weighted return, it does not consider the effect of those cash flows. So basically it isolates the cash flow timing, you can say. Okay, and by that extension, it isolates the performance of the manager. Now, this is where we have to be a little careful when we say this, because the CFA curriculum has consistently mentioned that time weighted return is a better measure of manager performance because it is the investor who has control of adding cash to the portfolio. That is the assumption. So when they say that the time weighted return is the preferred measure for evaluating the investment manager performance, we have to make sure that we are very clear on the fact that this manager that we are talking about, this manager does not control when the clients are adding or withdrawing funds. Okay. So we have to be very, very, very careful about this fact. That we have to make sure that we know that this manager is not in control of adding or withdrawing the funds. Only then it is a good measure of manager performance. Okay, so it isolates manager performance by eliminating the effects of cash flow timing, by eliminating the effects of cash flow timing. Okay, so the idea is very simple. The idea is very simple. We simply link all the holding periods returns together. Finish. That's your time weighted return. So time weighted return is nothing but, if you want to analyze it, in fact, you are left with geometric mean return only. It's not very different from that. So you price the portfolio, you value the portfolio immediately before each cash flow. Then you calculate the holding period return for each interval. Okay, and then you geometrically link all the sub period returns, and this is what you get: 1 plus HPR1, okay, multiplied by 1 plus HPR2 multiplied by dot 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 1 plus HPRT, okay, but small t we can write this whole thing minus 1. Now this is also, I think this is a place where we should be very careful, because I think the institute has directly written 1 over t in this formula, but I want to throw a word of caution over here. See, time weighted return and annualized time weighted return, those are two different things. Okay, so when we want to calculate annualized time weighted return, we will actually raise this to the power of t, 1 over t, sorry. This is annualized time weighted return. And generally, this is what the CFA Institute wants you to calculate. But in most of the books, you will find that if you check the time weighted return formula, you will not have this 1 over t written directly. And even, in fact, if you search over the internet, there is a lot of discrepancy regarding this. So to make this very, very clear, time weighted return is the linked return basically for each sub period, so that we are getting the total return for the entire period, for which we don't need to have this 1 over t in the power. But if the period exceeds 1 year, generally we take the geometric mean to annualize it, and that is why we raise it to the power 1 over t, and that is what the CFA Institute curriculum has done. Okay, so for the purposes of understanding, for the purposes of our calculations, we will always assume that we will raise it to the power of 1 over t, but we have to make sure that we understand that this is the annualized TWR that the CFA Institute is referring to. Okay, now before we take an example, I think we can write the advantages also. See, the advantage, of course, as we discussed, that it eliminates the effect of cash flow timing. So it is not sensitive to cash flow timing. It is not sensitive to cash flow timing. Okay, it measures the compound growth of a particular amount of money which is invested. Okay, so it kind of neutralizes the effects of deposits or withdrawals by the clients, and that is why it is a true measure of manager skill, because we are assuming the managers don't have control over the withdrawals. Okay, then there are some best practices also associated with it. Uh, when we do deal with time weighted returns, the valuation part that we do, when I told that we value the portfolio immediately before each cash flow, and we are interested in the holding period returns. It is best that this valuation part and the holding period return is done on a daily basis. This is the best practice in the industry. It gives you the best approximation. Okay, so for precision, this frequency should be higher. That is important. Now again, let's take the same example. The same example, we had three returns. In this case, we don't even need to worry about anything. In the previous case, we already know what are our three returns. Okay, negative 60%, then negative 60%, and then you had R2 was 40%, and R3 was 20%. So just calculate the geometric mean. That's it. That's your time weighted return. Finished. So what's the answer? What's the answer for that? Just calculate the geometric mean return. 1 plus 1 plus negative 0.6. So 1 plus 0.4, 1 plus 0.2 raised to the power of 1 over 3 minus 1. Quickly tell me what's the answer. Just send your answers. I'll be back in a minute. Okay. Yeah. Okay. So is everyone getting the same result? Negative 12.39%. These are simple calculations. Come on. 1 minus 0.6 is 0.4, then multiplied with 1.4, multiplied with 1.2. So 0.4 multiplied with 1.4 multiplied with 1.2. It gives you 0.672. Okay, and then as I told you, I will press y raised to the power x. Then instead of 0.333, I will press 3 and take 1 over x. So I press 3 and then I take 1 over x, which gives me 0.33 automatically, and then I press equal to. So I get 0.875904 minus 1, which is equal to negative 0.124096. So approximately negative 12.41%. That is your time weighted return. Okay, so the money weighted return and the time weighted return, they are hugely different. So can you see the difference? The money weighted return was positive because it was taking into account the timing of the cash flows. Let's go back and understand this properly. Let's go back and see why this was so high, why the money weighted return was so massively high, 27%. Can you tell me why? Anyone who would like to take an informed guess based on your level of understanding? Can you tell me why this money weighted return is so outrightly positive, whereas the time weighted return, compound rate of return, you can say compound growth rate, which eliminates the timing of the cash flows, that is negative 10%. So why this huge difference? Can anyone tell why? Yeah, but then why? It uses the money deposited as well. That is okay. So there is a difference. But then why it is so much positive? Can you tell me? Money weighted return. Logically, yes, there will be difference because it uses the money deposited as well. But just by seeing the timing of the cash flows, can you analyze something? See, you suffered your biggest losses in which year? Exactly, in the first year, right? And if you see the portfolio value, the amount that you had invested, it was the least in which year? The overall amount that you had invested, it was the least. Tell me, it was the least in which year? The least amount of money you had invested in which year? Your portfolio exactly was having the minimum amount in which year? First year only, right? Exactly, at point zero only. So the year in which you suffered the biggest losses, Niaz, is the same year that the amount of money was also minimum, right, in your portfolio. Agreed? Do you agree with this? Yes. So that is why the effect that should have happened, that negative effect, because this negative 60% did not dominate. Finally, you ended up with the positive return, 21%. Why? Because when the markets became positive, when the markets gave positive return, in those years, you actually invested more money. Your portfolio was earning higher. Got it? So that is why this big loss of 60% got nullified, actually, got neutralized to a large extent. Is the idea clear now? Is the idea clear now? Okay. How many of you have experience with SIPs? No, no, Niyas. It is taken into account, but it is weighted by money. The amount of money that you have invested when the return was negative 60%, that amount is very less. So the weight of that negative 60% is very less. Clear now? You only think, now, suppose there is you are investing a lot, right? Over a period of 1 year, let's say, or say 5 years. In the first year, the market moves very bad, but you invested the least in the first year. And then when the market becomes better, coincidentally, or because of information, or because of higher money that you had in the next years, you invested more. So you were lucky that your higher amount was invested in a period where the market was doing well. Okay, that is the idea. Okay, so if you have experience in SIPs, okay, if you have seen your portfolio, if you have the habit of tracking your portfolio, you must be seeing that there is a measure of return over there. They give you absolute returns also, and they give you something called as XIRR also. Have you seen that? What is that XIRR? Anyone who has seen this XIRR term? Anywhere. It's not only about the SIPs or mutual funds. If you invest anywhere, most of the apps nowadays have this XIRR feature. Okay, so it is basically the money weighted return idea only. The extended IRR, we call it. Okay. Anyways, not a part of the course, so we don't need to discuss too much. Okay, so we have discussed why this is a discrepancy where we are getting a negative 12.41% geometric return. Because see, this negative 12.4% is the true measure of manager performance, given that the manager did not have any control in taking out or adding the funds. Because the manager should be measured on the basis of the returns that the manager could have generated. Because if the client had decided to deposit a higher amount in the first year, the client could have suffered a massive loss. So that is why the true measure of performance for the manager is negative 12.41%. Okay. Now let us come to the comparison of two methods. So we'll just quickly see when we talk about money weighted returns. So money weighted return, as I told you, it reflects the actual investor experience. The actual investor experience. Okay. Money weighted return is sensitive to cash flow timing. Okay. And obviously, it is higher when more money is invested during strong performance. Okay. And time weighted return, it reflects the manager's skill. It reflects the manager's skill and it ignores the CF timing. Okay. Now let us come to the next part, which is annualized returns. Again, this part we do not need to do in too much detail today, because if you remember from the prerequisite readings, we have done this part extensively. This is the same idea where we calculate the present value from future value and future value from present value. So we don't need to cover this part extensively once again. So just for the sake of convenience, I'll just write that formula which we discussed. So future value, if you remember, say over a period of n periods, okay, this was equal to present value multiplied by 1 plus the stated rate or the quoted rate divided by the frequency of compounding, and then you multiply n by the frequency of compounding in the numerator. So this is exact same formula that we have done, and M was the compounding free periods per year. That's why I said compounding frequency. Okay. And basically the idea is that we are trying to adjust for the interest paid, which is paid more frequently rather than annually. And what were the common frequencies that we used? Remember, guys, what were the common frequencies that we used? What were the common frequencies that we used? Correct. Quarterly, monthly, annual, semi-annual, right? Okay. Fine. So if suppose we have a short period returns, we'll just take an example. So for example, let's say we have weekly returns. So if suppose you want to convert weekly returns to annual returns, let's say you earn say 0.1% weekly. So how many weeks are there in 1 year? 52 weeks, right? So basically the idea is that if you want to have the annualized return for this weekly return, basically what you do 1 plus it's 0.1%. 0.1% means 0.001 raised to the power of 52 minus 1. The same idea which comes from the future value formula, and we can derive it to the rates formula. So there is not much difference over here. Vice versa also we can do. Please tell me what is the correct answer. And again, I'm repeating, I'm not mentioning all the formulas once again. We have already done this for the rates also, effective annual rate, everything we have covered in the prerequisites. But since these things are important from the core readings, from the exam point of view, we are doing it once again. We are revising it once again quickly. What is the answer, guys? Okay, so I'll not calculate. Okay, I'm assuming that you've done the calculation correctly. So you're getting 0.05334 or 5.334%. Okay, it can be generalized to any number of days. You just need to divide by that number of days and raise it to the power of 365. So for example, if you have say a return for 10 days and you know that every 10 days you are earning return. So let's say every 10 days, and this is every week again, because this will only be true, this return over the year will only be true if this return is being earned every week. If you just earn it for 1 week, then of course there is no sense of calculating this. Similarly, if suppose we have every 10 days, and if we know that the return for every 10 days is, again, let's take the same number. Let's say 0.1% only. Okay, so what will be our annual in this case? So the general idea is that again, we raise it to the power of 365 and then divide it by 10 minus 1. 52 also we got like this only actually, if you see. Approximately, if we say 52 weeks in a year, basically 365 by 7 is approximately that, not exactly that, but approximately 52 point something, right? So that's why we say 52 weeks. So for what about annual? How much you're getting? So you need to raise it to the power of 36.5 now. Come on, everyone try and solve. Everyone should try and solve. 0.0371. Okay, 0.0371, or you can say 3.71%. So you can see that the same amount if we were earning every week. So basically over a shorter period of time, if you're earning the same return, so obviously the annualized return will be higher compared to the fact that you're earning 0.1% every 10 days. So if you compare 7 days and 10 days, obviously you will know that this annualized return for this has to be lower, because the same amount of return of 0.1% you are now earning every 10 days instead of 7 days. Okay. So this was about short period returns. What if long period returns are given? So the idea is again the same. There is no difference in fact. If suppose I tell you that, okay, I earned say 30% over a period of say 20 months. Okay. I earned over a period of 20 months. This you have to convert to annualized return. How will you do it? Will be equal to how much? How many months are there in a year? Of course, 12. So 1 plus 0.3. Remember, the core principle is the same. Over here, you have 365 days, or which means one full year is in the numerator. And in the denominator, you have that period. Okay. So again, in terms of number of months, how many months are there in a year? 12. And in the denominator, you will have 20 only. So the principle does not change. Whether you go from multi-year to annualized, or you go from short term to annualized. The principle stays the same. In the numerator over here, in the fraction, you have this one full year, whether it can be in the form of days, months, weeks, whatever. You see, this is also 1 year. This was also 1 year in the numerator in 365 days. And this is also 1 year in terms of weeks. Okay. So what is the result that you're getting? Okay. Is everyone getting 0.1704? Please check. I want a verification. Please verify. At least one person should validate this. Niyaz is getting 1.0179. Have you done -1? -1 you have done, Niyaz? Check it once again clearly. It should not even be 1.0179. You should get 1.17 something. You are doing 1.3 raised to the power 12 over 20. 12 over 20 is nothing but 3 over 5, which is actually zero point 0.6. So you have 0.6 in the power. Okay, 0.6. So basically you just raise 1.3 to the power 0.6. Come on, everyone should do. These are very simple calculations. What happened? Adil, why are you not performing the calculations? Jay Shankar, even the basic calculator, you can perform these calculations if you don't have the BA2 plus. That's completely fine. Karthik, at least be active. Please attempt the questions, send your answers. Don't worry if it is wrong or right. Richard, Sharon, Shubham, come on. Everyone should try. Send your answers. Then what is the point of having live classes? We should go for the self-paced course. If you have to say do it after the class, that is the main benefit of live classes, right? You develop this exam temperament, solving the questions together in the class. It builds your exam temperament. So don't worry whether the answer is right or wrong. Just do it in the calculator. Even if it is simple, obvious, please send your answers. Okay. Okay. Let's see. Let's see. I need validation. At least two answers should match, right? That's why I'm asking everyone to send. I'll wait. I'll wait. Sharon, come on. Richard, Karthik, Jayashankar, Adil, I'm waiting for some of your answers. At least some of you should answer. Come on, try and send your answers. This basic calculation you're not able to do, or you're not even interested in doing the calculation. Okay, I'll keep my mic on mute and I'll wait for the answers. Let's see. I'll continue when I receive the answers, okay? Because we have to validate anyhow. Okay, Richard, got it. What about others? Come on. Okay, Sharon is also getting 0.1705. So two answers are same. Now we have a validation. So the correct answer is 0.1704 or 0.1705 only. Okay, so we'll go for that 17.04 or 0.05%. Okay, next, what are the limits of annualization? See, just now I said that this return has to be earned every week. Otherwise, what is the even sense of computing? Only then 0.1% weekly every week translates to 5.33%. So only when it is earned every week, it translates to an annualized return. Okay, so this is the limitation, that first you are assuming two. In fact, there are two assumptions. If you see, there are two inherent assumptions. The first assumption that you are making is that the returns are being repeated in a very precise manner. Okay, that's the first assumption. Second assumption that you are making is that you are getting the option of reinvestment at the same rate. Okay, so reinvestment at the same rate. But in practice, if suppose by chance, if you earn, you have a very good week, let's say, and you earn, say, 3% over a week, then in practice or in reality, will this be equal to 1 plus, say, 3%, which is 1.03 raised to the power 52 minus 1 every year? Is it even possible? This is not possible in practice. This is not possible in practice. Market conditions, see, they change regularly. Constantly, market conditions are changing, right? So that is why we have to use these conversions, especially from short term to annual. We have to be very cautious in using these conversions. So it is okay for comparison purposes sometimes, but it is not at all okay for prediction purposes. Okay. Next is continuously compounded returns. Now, Again, in prerequisites, we have done this in great detail. The continuously compounded. In fact, we have derived the formula also, how it comes using limits and all. So I'm not going to go into too much detail once again, but from the point of view of this chapter, what is important, we'll just mention that. From the point of view of this chapter, whatever is important, we'll just mention that. So from the point of view of this chapter, the continuously compounded yield or RC is actually equal to ln of P1 divided by P naught. Okay. Or you can also say this is equal to ln of, if you remember the HPR formula that we did initially, if you add 1 to it, uh, and if there is no income, assuming there is no income, then you will get 1 plus HPR over here. Okay, where I'm assuming P1 includes both income and capital together. Okay, so if you want to make it more precise, you can also write P1 plus I1 divided by P naught. That's completely okay. So basically the ending value divided by the beginning value. That's the idea. That ending value can be in the form of capital gains and income both, or only capital. So ending value divided by beginning value. That's the idea. Okay. And we discussed all these things, how to do it in the calculator. In the BA2 plus calculator, you have the function which is available, ln function is available. It is the inverse of the exponential function, right? So let's say if you purchased a stock for say $150 and you sold it 1 year later for say $200. Can you tell me what is RC? Quickly, there is no income gain in between. What is RC? Quickly tell me. What is RC? In fact, first you can calculate HPR. At least we'll be able to compare, I think. Vivek and Karthik, we have directly calculated RC or this is HPR? HPR, of course, this is not SPR because 200. Yeah, this is RC directly. Okay, so RC you are getting as 28.5%, right? RC approximately you are getting 28.5%, correct? Okay, what is HPR by the way? In this case, there is no I, income is not there. So it's very simple to calculate HPR. 200 by 150 minus 1. How much is the HPR? Exactly, it is 33.3%. And remember, always, RC will always be less than the HPR. Okay. In fact, we can draw a graph also analyzing the tilt, but again, that is not a part of the course, so we'll not do it. Okay, fine. So, yeah, example we've already done. So, now let's come to specialized return measures. Now, when we talk about specialized return measures, we are basically trying to account for different kinds of fees, leverage, even inflation sometimes. Okay, in all the return calculations. So, when we talk about gross versus net returns, see what are gross returns? Gross returns are basically those returns which do not include any kind of fees, the management fees, admin fees, all these things. So basically, they are the returns which minus, you can say, only trading expenses, let's say, only trading expenses. Okay, commissions, brokerage, all these things can be there, intermediary fees. Okay, this gross returns, it actually, again, it is reflecting the skill of the manager. And of course, it excludes the fees, excludes the admin fee or even management fee, I should write, admin or management fee, whatever. It excludes everything. But net returns, it actually deducts everything, deducts all expenses, okay, including fees, costs, different kind of costs, okay, admin costs and all. And this is actually what the investor actually receives. This is something which the investor actually receives. Now, both matter, both are important because when you talk about gross returns will be helpful for manager comparison, right? Helpful for manager comparison. Whereas, of course, net return will be helpful for comparing the, you can say, investors, uh, investor experience. Okay, now one thing I can tell you for sure that when you look at the industry for different kinds of funds, say mutual funds. Of course, we are not going to talk about hedge funds right now because the scale is completely different. Let's say we talk about mutual funds or privately managed funds. Small funds will always have an disadvantage on a net basis. Okay, so small funds, you can say, are disadvantaged on net. Makes sense, right? Because they are small funds, they don't have too much assets under management. So maybe it's possible that the admin fee as a proportion of assets under management might be a bit high because they want uh, money as the management fees, right? That cannot be compromised too much on from the management side. But if the fund itself is very, very large, then overall that proportion of fees or cost might be a bit less. Okay, so that is an advantage for net returns in case of large funds. Now let's come to pre-tax and after-tax returns. See, when you talk about tax considerations, you have, and this is a debate or an issue which is always in focus, during the budget season in different countries. And even in the Indian Parliament, we have seen a lot of discussions regarding the capital gain, LT, long term capital gains tax as well. So, under capital gains tax, see, capital gains tax means what? Whatever price appreciation happened in the asset, on that appreciation, you will be taxed. Okay, in this case also, the short term capital gains taxes are generally different as compared to the long term capital gains tax in most of the countries. Okay, so there is a difference between short term versus long term capital gains tax. Okay, then generally, again, not always true, generally in interest income or the income gains, I should say, generally in income gains, okay, in fact, even under income gains, there are different categories. You have interest. Interest income is generally uh, taxed using ordinary normal rates, the ordinary tax rates, ordinary income tax rates. Okay, ordinary income tax rates. But the dividends may be taxed differently. Okay, so they may have some kind of, you can say, preferential kind of treatment. Okay, preferential treatment. So obviously, if you want to calculate your after tax return, okay, after tax return will be what? Your total return or total net return, you can say, minus your tax liability. Okay, so this is your after tax return, the total return minus your tax liability. Okay, next you have real returns. This is something which we've already discussed, that you basically adjust for inflation in this. You adjust for inflation in this in case of real returns. Okay, you can do it either using an approximation or you can use the exact formula. So if you want to use the exact formula, the approximation we know, the approximation was what? Real return was equal to the nominal return, if you remember, the nominal return minus the expected inflation rate. Okay, so inflation. And if inflation is already known, then you can adjust it after the inflation rate is known. So you don't need to write the word expected. So minus inflation rate. But this is an approximation, remember. What is the actual formula for adjustment? The actual one will be based on that interlinkages that we did via compounding, right? So in that case, the real return will be equal to 1 plus the nominal return divided by 1 plus the inflation rate, okay, minus 1. Because that was the formula, right? 1 plus real return multiplied by 1 plus inflation rate was equal to 1 plus NR. So I've just adjusted the formula to give you the real return. Okay, that's the idea. Next, you have after tax real return. So if you talk about after tax real return, now first let's discuss after tax return and then we'll see after tax real return. Okay. So after tax nominal return first we'll calculate, and then we'll see, we adjust for inflation, and then we get after tax real return. So let's take an example. Suppose in a country there's an investor who is falling in the 30% tax slab or tax bracket. Okay. And the investor, let's say, and we are not considering normal income, we are just considering that part of the income where we are having say incomes and capital gains, those kind of income, so investment income basically. Okay, so let's say you have an investor where the pre-tax return for the investor is equal to, say, something like say 15%. Okay, and you have say 5% say dividend income. Okay, and let's say you have 10% capital gains. Now these capital gains are taxed at, say, let's take it little less than 30%. Let's make it 20%. Let's say it is taxed at 20%. Okay, those 10% capital gains. And this dividend income has no preferential treatment. It is going under the normal tax slab. Okay, normal tax rate. Okay, of 30%. So what will be the after tax nominal return, which we'll call as ATR right now? I'm not calling it as ATNR. We are assuming that when we say after tax return, we are talking about after tax nominal return. So if you see this 5% dividend income, which is being taxed at 30%, you think about it. If 30% of your 5% gain is taxed, how much are you left with? You are left with 70%, right? So this is how you calculate it. The way to structure the formula is like this. You write 5%, 1 minus the tax rate, which is 0.3. So basically it signifies that you are left with 70% of 5%. Plus this 10% is being taxed at less than 30, which we took as 20. So this 10% multiplied by 1 minus 0.2. Okay, so what is the net answer? What is the net after tax return? And mind you, this is nominal right now. You're not even adjusted it for inflation till now. How much? Is everyone getting the same? That's 8% plus 3.5. It's correct. 11.5%. So you see, if you compare it with the return before tax, pre-tax return of 15%, the investor is on a percentage. I'll not say on a percentage terms because I'm not taking 15 per how much percentage of this is 15 or 15%. I'm just telling the difference in percentage. So you see, a total of 3.5% has been just wiped out from the gains. Okay, if you compare it in percentage terms, so you see the total reduction is actually 15% minus this 11.5%, which is actually equal to 3.5%. Now, in percentage terms, how much percentage is wiped out? 3.5% divided by 15%. This is how much? Can you tell me? 3.5 by 15, 23.3. So 23.3% of your gains have been wiped out just because of the tax liability. Now, over decades of compounding, this tax drag itself can reduce your final wealth or terminal wealth by a huge amount. Huge amount. Okay, maybe more than 40-50% compared to the situation if you had not paid the tax. It is possible. Okay, over decades, again, I'm saying. But again, still, this is about nominal returns. We have not even adjusted this for inflation. Okay, so if you adjust this for inflation, now this inflation is, let's say, somewhere like say 3% inflation is there, then your actual return, the net return that you are getting is 11.5% minus, in fact, let me just change the color, that will be better. So if suppose inflation is 3%, then the net return that you are getting is 11.5% minus 3%, which is actually equal to 8.5%. This is your after tax real return. Okay, that's the idea. Okay, now let's come to leveraged return. So we discussed about leverage in the beginning in financial statement analysis also, and we introduced leverage a little bit in quants also, but we discussed leverage in more detail in FSA. Now, in this particular chapter, when we talk about leverage, we talk about two kinds of leverage in this particular chapter. So, in layman terms, you can say the leverage return is the return that is earned by any investor that is like a multiple of the return on the underlying asset. So, on the underlying asset, if the return is say 2%, then your leverage return becomes a multiple of 2%. That can be achieved via different methods. Okay, but in this particular chapter, we are considering two methods. One is via borrowed capital. So basically, you are using debt to increase your investment size. Okay, also via derivatives, which we are going to discuss in great detail in the derivatives module itself. In fact, derivatives is a separate module in the CFA Level 1 curriculum. Okay, and even in FRM Part 1, we have extensive coverage, or in fact, much higher mathematical coverage of derivatives as compared to CFA Level 1. But in CFA Level 1, Level 2, across Level 3, we have a very decent coverage of derivatives. So we'll discuss that part later on. So basically, the idea is we try to control very large positions with small margins. Okay. For example, if you are say dealing with, I'm just giving an example, there is something called as the futures contract. Many of you might already be aware of this, but those who are not aware, we'll deal with the derivatives segment later on. So there is something called as the futures contract where, let's say we talk about say commodity futures. So in commodity futures, we have gold futures, silver futures, crude oil, natural gas, lead, zinc, copper. A lot of things are there. Okay, precious metals, base metals, energy segment, agriculture segment. Let's say in commodity futures, I mean, if you open the Multi Commodity Exchange website of India, MCX, you can find those margin details also. So the idea is that just by investing 5% of the amount of the underlying asset, you are able to control that full position. Okay, so you have a leverage of 20 times. You can see if you're only paying 5% margin, you are having a leverage of 20 times. But of course, it hurts both ways, right? If gains are amplified, losses are also massively amplified. Anyways, let's discuss the context from this chapter's point of view. So when we talk about leverage returns, the formula for leverage returns is this. RL, or the leverage return, is given by RP plus VB divided by VE multiplied by RP minus RD. What is VB and what is VE? VB is basically the amount that you are borrowing. So B is for basically debt, borrowed funds. E stands for equity, basically your own money. That is what we are representing. We represent VE as equity, the value of the equity, but that's our own money basically. And VB is the amount of borrowed funds. Okay. Then there are some costs also, the cost of capital also. So when you talk about this RP, RP will be the total return on the portfolio or the total return on the investment, you can say. And RD, in fact, let me just write this as RB because we are assuming that B is my borrowing, not debt. Or else if VD also we can write. This will be better, in fact. This will be more technically precise. VD is basically the value of the debt or value of the borrowing. V is the value of equity or your own amount of money. RP is the return on your portfolio, and RD is the cost of borrowing, basically. The rate of borrowing, the cost of debt, whatever you want to call it. Okay. So before we continue, we can just take a very simple example. Let's say you borrow debt, okay, and you have uh, a total portfolio size of say $1 million. Okay, and your portfolio return is equal to say 12%. Okay, then let's say the amount of debt that you are taking is approximately, say, let's consider 40% debt. Okay, you have financed this with 40% debt. So obviously, if 40% debt is there, which means that the equity is how much? 60%, right? So 60% equity means what? $600,000 of equity, and 40% debt means $400,000 of debt. Okay. The total return on the portfolio you get is 12%, let's say. And uh, yeah, this will be your VD. This is your VE. Okay. And the cost of borrowing is say 5%. Okay. So what is the leverage return? Quickly find out the answer and then we'll continue. First, tell me what is the leverage return? What is the leverage return that you are getting? Calculate quickly and your answers, how much you are getting. So RL is equal to 12% plus VD by VE. I don't even need to write the actual numbers, even if I write 40 by 60, that's okay, completely fine. I can write 400,000 by 600,000, whatever, it's completely fine. So let me just write 40 over 60, 12% minus 5%. Okay, so all of you are getting 16.67, right? So this will be 7. Okay, and 2 by 3, so 14 over 3. 14 over 3 is 4.667 plus 12%. Absolutely, yes. So 16.67%. That is your leverage return. The actual return on your portfolio was 12%, but since you borrowed it, you actually amplified your position, you leveraged your position with 40% debt, your actual return is much higher, 16.67%. Now, there are a few things to understand that leverage will increase your return only when your actual portfolio return or RP is greater than the cost of borrowing, which makes sense, right? It will increase return, which means RL will be greater than RP only when RP is greater than RD. Because if suppose the portfolio return that you got, that itself is less than the cost of borrowing, then in fact you have to pay more for the debt and you're getting less actually, which means this term will become negative. So that's why this RL will be less than RP, which makes a lot of sense. Okay. And it is very important to understand that this amplifies both gains as well as losses. Okay. And later on, you will see that when we discuss margin trading, when we discuss derivatives, the idea of leveraged returns will be becoming more clear to you, in the other terms. But for this chapter, only this part is important. The numerical examples of margin trading derivatives are not a part of this chapter. For this chapter, only this formula is important. Okay. So example we've already done. Then, okay, now return calculation workflow. So now let's come to the theoretical part of this chapter where we are trying to discuss the systematic framework, okay, that investment return measurement actually requires, okay, so that it can account for different dimensions. You can have time periods, you can have averaging methods, you can have fees, taxes, inflation. All these things are important, right? In the framework has to be very consistent, it has to be comparable. Okay, it has to make sure that the investments that you are analyzing, you are doing performance analysis in a meaningful way. So what is the sequence? The sequence of or the workflow is basically first you collect data. Okay, so you calculate the holding period return, you collect the data. Okay, you calculate the returns, the HPR or whatever return measure is important. Okay, then you choose the right type of means which are required. You want arithmetic mean, you want geometric mean, you want harmonic mean. What do you want? Okay, so that is the third part. You choose the means. Okay, and Then you adjust the cash flows, and different kinds of adjustments can be there. So you adjust the cash flows. What kind of adjustments? You can have time adjustments, you can have fee adjustments, you can have tax adjustments. Okay, you can have, of course, inflation adjustments. Okay, so you need to be adjusting these cash flows, and then your final return will actually quantify the actual wealth that you obtained, okay, towards the end. So the important point, the critical decision point, I'll say, is that you have to match the return measure to your question. What is the question? Are you trying to compare manager skill? So if you are trying to compare manager skill, tell me, I mean, I'm just giving an example over here. Example, let's say the question is to uh, compare manager skill. This is the question. Okay, if you're trying to do this, can you tell me what kind of return you should use? We have discussed this today. What kind of return we should use? Yes, so everyone is answering correctly, time weighted. But do you think we should add something to this? Yes, time weighted definitely. But then we also discussed gross, net. So gross or net for manager skill. TWR is correct. Absolutely. So we need to add another identifier, the gross TWR. If I ask you another example, let's say the question is that you uh, you want to evaluate your own success, your own personal investment success. Let's say, if let's say the question is about personal investment success, then what kind of return you will use? Exactly. Very good answer. It should be net MWR. Very good. Okay. If you want to make investment selection decisions, then of course you will use the after tax real returns net of all fees. So the question is very, very important. Okay. Next, the Excel functions, some of the Excel functions which I think you all should know. Uh, you should try and use these functions. Obviously, you know average function, right? The arithmetic mean return, it will calculate the average. Then you have geo mean function. It will give you the geometric mean. You have the HARMEAN function. It will give you the harmonic mean. And finally, from today's point of view, today's chapter's point of view, one function is very, very important for money weighted return. There's a direct function in Excel, which is the IRR function. So you can try and experiment with these functions in your Excel sheets. Okay. Now let's compare asset classes. Okay. See, this is just a comparison over the years. Okay. So, and this is for real returns. In fact, this should have been written, I think. This is actually for real returns, inflation adjusted real returns. So over time, the equities, just a minute. I think, wait, T-bills more than two. No, I think, sorry. Inflation is also given. Na? We need to compare. Let me just, let's compare real returns. Okay. And inflation is given. So this graph is telling you nominal return. This graph is actually giving you nominal returns. So assuming, let's say the inflation to be somewhere around the 2% mark. Let's just assume hypothetically. Okay, this is more than 7.5, right? 7.5 is in between, less than 8. Okay, so 7.8% for corporate bonds have 6 point something, right? So let's say it is 6.3%. For T-bills, you have almost very similar to inflation levels. T-bills are just protecting your money for inflation. That's it, nothing more than that, 2.4% approximately. Now, if you compare the real returns, for equities, what is the real returns? For equities, what is the real returns? Approximately, I'm not asking you to calculate exact, just subtract the nominal returns minus inflation. That's it, Karthik. I just want the approximate number, Karthik. Okay. So yeah, 7.8 approximately, yeah, 7.8% minus 2%, which is approximately 5.8%. Okay, what about corporate bonds? What is the approximate real return for corporate bond? 6.3 minus 2, which is 4.3%. Correct? For T-bills, what is the real return? So 2.4% minus 2%, which is approximately 0.4% only. So these real returns help you to perform meaningful comparison across asset classes. Okay. Now we have just calculated the approximate real returns from this graph. Now, what are risk premiums? So risk premium in this case, see, we discussed different kinds of risk premiums in the beginning today, okay? But from this graph, we can establish some premium. See, premium is basically the difference between two returns. And generally, when we talk about premium, it is generally a compensation over the risk-free rate. And what is the best proxy for risk-free rate? The T-bills rate. So in this case, we will assume that the risk-free rate, the real risk-free rate is 0.4%. Okay, and the nominal risk-free rate is 2.4%. So if I want to find out what is my equity risk premium, what is my equity risk premium? So equity risk premium is this 5.8% minus the risk-free rate of 0.4%. Again, in real terms, both I am writing. So this is 5.4%. So what is risk premium? Risk premium is the compensation that investors are demanding over the risk-free rate to invest in the equity markets. 5.4% on an average. Now, in general, if you talk about the credit risk premium of corporate bonds, again over T-bills. So what is the premium for corporate bonds over T-bills? What is the difference between corporate bonds and T-bills? Correct. 3.9%. Absolutely. So basically just the difference, 4.3 minus 0.4. 4.3% minus 0.4%, which is 3.9%. So to invest in risky bonds, investors are and I should say to invest in credit risky bonds, because right now we are only considering credit risk because we are assuming that these T-bills will not default. They have the full faith and backing of the US government. Okay, although theoretically they can, but practically this has never happened. So it is the best proxy for risk-free rate. But if you want to invest in credit risky bonds, which are not backed by the full faith of the government, which can have default risk. Credit risk means basically we are concerned about default risk over here. Okay, or the credit risk, credit spreads widening. There are a lot of credit events which we'll see later on, but that is the main idea behind credit risk. The major component is default risk only. So 3.9% is the extra return that will be demanded by the investor to hold the corporate bonds. And in equity only, see, corporate bonds are basically bonds of companies. So two things are being traded of companies, bonds and their shares. Even in the companies, you see, there is a spread. We'll call it the equity bond spread. The equity bond spread. So to invest in the company, you have two options. Either you can lend the company. A company finances through two channels, right? A company will either finance through equity or through debt. So if you become a lender, you will become a bondholder of the company. So in that case, you are getting 4.3%. Okay, but if you invest in equity, you are getting 5.8%. Okay, so that's an ownership interest, right? In that case, the company does not promise you timely payments just like it promises for bonds. We know what is equity, right? Equity means it is like an ownership stake in the firm. And all these segments, equity, fixed income, corporate bonds, all these things are discussed in great detail in their respective modules. As I said, we have a separate module for fixed income. We have a separate module for equity as well. But I'm just introducing it right now for those of you who are not aware. Okay, so what is the equity bond spread? What is the equity bond spread? What is the equity bond spread? Yes, that also we can discuss, Nias. As of now, As of now, we are focusing only on the real returns, Niaz. Even if you focus on nominal returns by including inflation, still you will get the same result. In terms of spread, you will not get anything different, because whether you do this 5.8% minus 0.4%, or you do 7.8% minus 2.4%, the result is the same. Okay, Niaz. Inflation, we are adjusting for inflation because we want to discuss in the terms of only real returns, Nias, inflation adjusted returns. So my last premium is the equity bond spread. So can you tell me what is the equity bond spread? Equity real return is 5.8%. Bond real return is 4.3%. What is the equity bond spread? Correct. 1.5%. So it means that even for a single company, if you want to invest in the company's bonds, I mean, and this is an average, guys. This is an average. I'm just taking an example of a single company just to make things simple. This is an average of the equity market and the bond market, the data which is given to us. So the idea is that even for similar companies, even for corporates, even for the same uh, structure, the same firm, for different asset classes under the same firm, you will pay different risk premiums. You will pay different amount of, or sorry, you will expect different risk premiums. It means that if you want to invest in the bonds, you will expect that your return will be, real return will be 4.3%. But if you invest in the equity of the company, you will get a little higher, 5.8%. So which one is riskier as compared to equity and bonds? This data clearly tells us which one is riskier. Exactly. Equity is riskier. Okay. So equity. So whichever is having a higher spread is considered to be riskier. That's the idea. Okay. Now let's discuss the performance evaluation framework, and we start with manager performance metrics. Again, this is just a revision of what we have done till now. So the first, when we discuss the gross return. So gross return, basically it measures the manager skill before any fees is accounted for. This is gross return. Okay. Then, in fact, I've already discussed when what kind of questions that we ask and what kind of answers we should have for the returns. So it is basically this extension of the same idea. We use net return to assess the actual investor experience. Okay. And we use time weighted return to neutralize the cash flow timing. Okay. Now, if you talk about investor centric metrics, see, basically, we are just trying to give the complete picture over here from the investor's point of view. We are trying to remove a cost or adjustment at every single layer. We adjusted for a lot of things, right? We adjusted for taxes, we adjusted for inflation. So different layers we are trying to remove. Okay, each layer is removing another cost or another adjustment. And of course, my true wealth change, the true wealth change from the investor's point of view is always your after tax real return. After tax, in fact, this R, since I have written earlier in small letters, I will use small letters here also. After tax, the real return. Then what are the best practices? The best practices, we in the context of this chapter, there are three things which have been discussed. Consistency has been discussed. Now, consistency means basically you need to use the same methodology across different periods, and you need to document your calculation methods properly and consistently. Then there should be transparency. You need to be sure that the managers, they disclose all the, and this is from the perspective of the investment firm. Basically, the best practices that we are discussing, they are from the perspective of the investment firm, okay, or the manager, that the duty of the investment manager. Then the manager should make sure that they disclose all the fees and expenses and explain any kind of adjustments that have been made. And finally, the context is very, very important. See, the manager has to make sure that this the return that he or she is able to generate, or the firm is able to generate, the manager's firm, they have a proper comparison to appropriate benchmarks. Okay. And also they consider risk adjusted measures, about which we have already introduced in prerequisite readings. But since we have not done portfolio management till now, we will cover the risk adjusted measures part later on. So this is the context. That comparison is important. So for the context part, I think I should mention over here that uh, they should be a proper comparison to benchmarks, and risk adjusted measures should be considered. Okay. And transparency, what we discussed, disclosure, right? And also the explanation of different kind of adjustments. This is important. And consistency, use same methodology across different periods, right? Across periods. Okay. And documentation is very, very important. Of all the calculation methods that have been done, the documentation is very, very important. Okay. So the issues, I mean, along with the best practices, we also need to understand the issues that we need to avoid, the pitfalls that have to be avoided. So we start with survivorship bias. And I think many of you might have heard of this term, survivorship bias. What is survivorship bias? Anyone? What is survivorship bias? The main name itself, survivor. What is the meaning of this? It means that you are just considering your surviving investments. You are excluding the failed investments, which will actually distort your historical returns. Because if you analyze only companies which have survived, or those funds which have survived, it will actually overstate the average returns, because the failed investments, this completely disappear from the data set. Okay. And this is actually a very common issue in mutual fund databases. In mutual fund databases, they actually exclude funds which we call as defunct funds. Okay. Because of which the average returns, they seem to be a little inflated. So that is very, very important. Okay. Next is that uh, you, I mean, what we call this as cherry picking, right? Cherry picking favorable time periods, I'll say. Because what happens is, if suppose you are a manager and you are selecting favorable time frames where the investment, your fund or your investments are performing very well, this will actually mislead the investors. Okay. Next is ignoring risk. See, if you are just concentrating on returns, higher returns, higher returns, higher returns, but you are not even considering the context of risk, that is that information itself is not complete. Because how much risk you are taking to earn that return, that is also very important. Somebody who invested in, let's say, uh, Shiba Inu, I think there was a very uh, big buzz, if around, I think 4 3 4 years back, right? 3 years back, around this Shiba Inu crypto coin. So somebody who invested in Shiba Inu, and they earned say 10,000% in 6 months. That 10,000% of return during COVID time. Okay, okay, wait. So I think after COVID, post COVID, I think it was, if I'm not wrong, 2021. Yeah, yeah, 2021 was COVID only, right? Yeah, 2020 it started during COVID time. Yeah, after that, I think 2022 beginning also we heard about these things. Yeah, or maybe 2021 end. Correct. So the problem is that you are ignoring the risks. There was a very high probability that you could have lost all your money. Very, very high probability. So the risk was also very high. Okay, so crypto investments and private equity investments cannot be compared to low yield bond investments without considering the risk parts. Okay. Next is adjustments are wrong. Annualization is not correct. So you can say incorrect or inappropriate annualization. Okay, we discussed this, that weekly returns, 10-day returns, 15-day returns, short term returns, all these returns, they don't reliably predict the long term results. They may not repeat. So the annualization has to be done properly. Okay, that is very, very important. Then don't ignore the impact of fees. Don't ignore the impact of fees. Because if you focus only on gross returns and you're overlooking all kinds of impacts because of the fees, that is leading to unrealistic expectation. See, as I discussed about tax, decades of compounding and all, the same thing applies to fees also. If suppose you only have a 2% or 3% or 4% annual fee, it may seem small, but again, over decades, 30, 40 years, it can reduce your final wealth by a huge amount because of compounding effects. So that is why the net returns are more important. The impact of fees has to be considered. Also, do not confuse between different kinds of means. Confusing between means, or specifically you can say AM and GM. Okay, AM, GM, etc. If you are using arithmetic mean for compound growth, what we saw today, it is biased upwards. Like we saw that geometric means was actually negative. The wealth was actually going down, but the arithmetic mean was positive. We have seen this example in the beginning today. So arithmetic mean is appropriate for forecasting single period return only. But if you have to measure compound growth, you need to measure it with geometric mean. Okay, that is important. Then you can have, yeah, ignoring inflation adjustments. Inflation adjustments, that is very, very important. So if suppose you are evaluating the nominal returns only, you're not considering real returns, then not a good idea, of course. Then have we mentioned taxes in the pitfalls anywhere? Fees, yeah, ignoring taxes. So ignoring taxes is also a problem. Then confusing between means also applies to misapplication of money weighted versus time weighted. Okay, so you have to be very careful. Again, the question is very important. What kind of question we are discussing, that is very, very important. I think these are the only pitfalls, okay, that you need to avoid. Okay, while you as well as the manager. I mean, this applies to the entire investment philosophy. Okay, so what are the key takeaways from this chapter, and then we'll just end the session. So what we discussed today, we discussed that there are components. We started with components of interest rates, right? So because of those components, we have different kind of risk premiums. So we discussed risk premiums. Okay, we discussed uh, real risk-free rate, and then inflation premium. Nominal risk-free rate is a combination of real and inflation premium. All those things we discussed. Okay, everything will come under risk premium only. Then we discussed different types of measures. We discussed AM, arithmetic mean, geometric mean, harmonic mean measures. Okay. Then we discussed time weighted return versus money weighted return. All these things which are important from today's chapter's point of view. And then we discussed the tax implications, tax part. Okay. And finally, we discussed the leverage part. Okay. So these were technical part. And then in the theoretical part, we discussed the workflow and the pitfalls, right? Mainly, of course, we discussed a lot of other things as well, but mainly the conversation was around these points only today. Okay, fine. So that's it for this chapter. So we'll just end the session for today. Thank you so much.